Good evening, everyone. Welcome to the Power of Passive Investing meetup. We have our co-host today with us, Chicago, who is the investor host. I know you did. Sorry, I missed Folks, you. If you're not speaking, can you please put yourself on mute? Thank you very much. Let me just, as usual, share a few things with you before we have our presenter. Share screen. Okay. You see the full screen now, right? Perfect. Okay. We have an excellent presenter tonight. Anna Kelley is a seasoned real estate investor. She's been investing in real estate for many years. She started investing while working full time and while raising 4 kids. I'm sure she's going to tell us more about it. But at this point, she has a portfolio of, I don't even know what the AUM is. It 80 million, 100 million? And we'll have to hear from you how much it is, but it's an extensive portfolio ranging through multiple states, Pennsylvania, Georgia, Texas, and I'm probably forgetting another state or two. She's very passionate about helping other people, and she's really passionate about real estate investing and networking with other people and just sharing her expertise and spreading the word. So we'll hear from Anna today. The usual legal disclaimer that I typically share, this is only for educational purposes and nothing's been sold here. So take it for what it's worth. The housekeeping, again, keep yourself on mute while we have the presenter going through the stuff. If you have any questions, you can unmute yourself at the end, or you can post your questions in the chat box, and I will read them when the presentation is over. And I am recording this, so I'll be sharing recording with whoever cannot enter in. Oops, sorry, whoever cannot join us right now. Okay. Our next meetup is on the 17th, but because it's during the holidays, Chike and I decided to make it into pure networking. So we're not going to have a presenter. It's going to be just pure networking, going from one room to another. So please join us. You'll have an opportunity to meet a lot of folks that are here today and will be with us on the 17th.
No, that's okay. I'll go over here.
There is also, for those that are interested in more events, there is a virtual private equity summit where I'm presenting next week. This is the link. I can post it in the chat if anyone is interested. And this is my contact information in case you guys want to contact me and have any questions. That's all for me. Chike, you want to say a few words?
Yeah, I'll keep it short. Definitely. Thank you guys for coming out. I know you'll get a lot of value tonight. Looking forward to connecting with you guys at the next event where we can, kind of change the pace of things and actually network and try and get some of that value that we have been missing out on in the in-person events that are, currently on pause. So thank you guys, and stay tuned tonight.
Thank you, Chike. And now we are thrilled to have Anna Kelley with us. As mentioned, she's going to talk about the challenges one goes through while buying properties during the pandemic and beyond. Anna, we're thrilled to have you with us. The floor is yours.
Great. Thank you so much, Alina and Chike, for having me, and all of you for coming in to hear what I have to say tonight. I hope that it is valuable to you, and I apologize in advance for my kind of shadowing. I just moved into a new home and I'm hiding out from all of my kids. We're kind of in the same area while there's construction going on. So I'm literally hiding in my closet, but hopefully y'all can hear me okay. Can everybody hear okay?
Yeah, we can hear you well, and your closet looks pretty spacious, so enjoy it.
The hallway between the two closets. Great. Okay, so I'm going to go ahead and share my screen here with you. And I'll just ask one more time if you can see my presentation.
Yep, we can see it. Looks good.
Wonderful. So tonight we are going to talk, as Alina said, about investing during a pandemic. And I just want to talk to you a little bit about navigating some of the operational challenges that we've seen, as well as recession resilient investing strategies. Because one of the things that goes without saying is that even though we're in a pandemic, we're also in a recession. And basically, a lot of the challenges that arose during the pandemic were already starting to present themselves when we were ending the longest expansion period in history since President Abraham Lincoln was in office before we hit another recession. So we had a lot of rumblings of some economic downturn on the horizon right before COVID hit. And then COVID kind of expedited and exacerbated some of those issues. So by understanding economic cycles and understanding recessions, it allows us to be able to also be able to navigate better the pandemic than those who kind of caught not understanding some of the underlying economic issues that we were having before even going into that. So just a little bit about myself. My name is Anna Kelley. My branding is REI Mom. And as Alina said, I am a real estate investor.
I didn't order anything.
And those two things together created REI Mom. So through our REI Mom, I speak at events across the country. I am a coach, and really my passion is to be able to help other people, especially women, to overcome their fears, increase their knowledge, and minimize risks in real estate. I've been blessed to be a #1 Amazon bestselling author of 3 books in the last 2 years, and I'm working on the 4th one now. I started a company called Greater Purpose Capital, and my company is a real estate company dedicated to creating meaningful impact in the communities that we invest in. So for me, it's a lot more than just returns for myself and my investors, but as someone who grew up in Section 8 housing and really had nobody to show me anything about finances and how to break the cycle of poverty, it's really important to me that when I invest, that I'm investing in an impactful way to make a difference in the lives of the people in our complexes. Just at a high level, before I started investing in real estate, I was a top-ranked financial relationship manager for a private bank. And then through recognizing that my very wealthy clients, a lot of them had real estate, my interest was piqued into saying, one day when I have money, I want to buy real estate. And that led to about 20 years of investing. I currently have active ownership in a multifamily portfolio valued at just over $160 million across almost 1,200 doors. And I've invested passively as well, and still invest passively in other people's doors in about 2,500 at this point. So what I want to talk to you about is really one of the most important factors in successful investing in real estate for the long term. And knowing economic factors that will impact real estate and your chosen niche, and in our case, that's multifamily, is really critical. Not understanding just your local economy, but also state, national, and even global conditions is really important. Okay, so one of the things that you've got to understand is that both macro and microeconomics, global and national economic factors and regional and local economic factors can all impact you in your investing in any one particular investment strategy or region that you're investing in, or a particular asset class at a certain point in time. Employment growth, building costs and prices, whether your area has strong inflation, what interest rates are, trade policies, tax policies, political environment, different legislation can all impact the national economy, the global economy, and the local economy. And what I've learned most importantly over my 20-something years of investing is that understanding these economic factors is critical to making investment decisions. So when I look at any investment decision, I'm always looking at where are these things today? Where do I think they're going in the next 5 to 10 years? And how might that impact my decision to make an investment either passively or actively? So I've learned that we really need to start understanding real estate cycles. So real estate cycles essentially go from recession when you're down to a recovery period to a growth period until you lead up to the peak, or in some models, they'll show that as the hypersupply section or cycle of growth. And essentially, economies are always changing and they continue to go through these same 4 cycles. We can't predict exactly when, but we can see signs and start planning accordingly for the best probable outcome through these changes. And I'll talk a little bit about further in the presentation 2008 and 9 and how I was a bit blindsided by them, despite being in private banking and working with investors and working at AIG for 20 years. I really didn't understand the economy as well as I should have as an investor. And that precipitated me to become a student of economics after that. We also need to understand general economic cycles. So while we've got real estate cycles, we also have coordinating side-by-side economic cycles of expansion and contraction, where expansion periods are when you're starting to recover from a recession or a depression, and when you're in the growth phase. And then during contraction, you're basically starting to have the economy contract, leads to recessions and sometimes into depressions. And we need to understand how these cycles can actually impact the value of the real estate that we own or that we want to purchase, the rents that we can command for that real estate, consumer sentiment and behavior that will impact our renters and whether or not they want to rent a particular complex from us. It will impact lending guidelines and the ease or difficulty in which we can obtain financing. And it impacts strongly supply and demand, all of which are critical decisions that we need to make around these things. We also need to understand how local factors can impact our real estate values, rents, consumer sentiment, lending guidelines, and supply and demand. So all of these things can actually impact it. A few of the local factors that I look at strongly when I'm looking to invest is industry diversity. And you'll hear many people say the same thing. Ideal assets are well located in areas that are going to give us the best possible outcome for long-term appreciation of values and stability of occupancy. And so if we can invest in areas that have a diverse industry with the diverse number of employers, type of employers, and quality of employers, we build in some resilience for long-term investing in those areas. I look at school quality. Poorer schools will yield more turnover and a lower quality tenant. When you have stronger schools, people tend to want to stay in those areas and they will pay rent. And even if rent is more expensive than they typically can afford, they will continue to pay to keep their children in good schools. I look at crime levels and income levels, all of which will impact your values, your rent levels, et cetera. Numbers of renter households versus supply is very, very important because like anything in economics, profitability is based primarily on supply versus demand. If you have something that not a lot of people have, but a lot of people want, you're going to be able to charge a lot more money for that. If you have something that not as many people want as you have, then you're not going to be able to charge as much. And so knowing the supply and the demand and the number of renter households in the areas we invest versus the number of renter units that are available is of critical importance. Local legislative bent is also extremely important. So whether or not you are politically conservative or liberal, regardless of how you view economics and whether you should be economically conservative or liberal, As an investor, I want to invest in conservative areas where there's a conservative local legislative bent, where it's more landlord friendly, where there are lower taxes, and therefore tends to be stronger local economies that bode well for investing. And then also risks of disasters in a locality can impact your valuation and your rents. So different markets and different local economies and asset classes within them really bring different risks and environments that are most conducive to different types of investment strategies. And this is something I don't hear people talk about very much, but to me, it's very, very important. Many multifamily investors believe that the only way to do it is a value add. And many multifamily investors say the only way to do, really long-term investing is to buy and hold and never sell them. There's other investors that they're always looking to do major repositions because they want the big bang for the buck and the big growth and the big check at the end. And what I want to propose to you is that whether you are looking for buy and hold deals, value add deals, or a major position should in large part depend upon the economic cycle and the real estate cycle in which we are today and at any given point in time. So for example, we'll talk about this a little bit, when you are in a growing cycle and you're nearing the peak, then values are continuing to go up. And so if you buy a property at a decent price, you manage it fairly well, you don't make any huge mistakes, you're going to have that rising tide rise your ship and you're going to be able to do well. But if you're in a recession or you're heading toward a depression or you're at the very peak of hypersupply and values are going to come down, I do not want to be stuck with a value add deal, selling sexy high-end finishes to people that are struggling financially that are going to say, I'm not going to pay for those things. I need to prioritize, shelter and cut back, and then they want to downsize. So I look at value add as a really great strategy when you are in a growing, recovering, growing stronger market. And I look at buy and hold deals really through all economies, but especially when we're in a recession, I'm looking for deals that I can hold that are going to do well for me in cash flow for the next 5, 7, 10, 20 years. And so if I'm buying them as buy and hold, then I don't have to worry as much, how long is this pandemic or is this recession going to last? Am I going to have to try to churn and get out of this deal in 3 to 5 years to make my investors happy, that they're constantly churning that money and increasing their IRR? Or can I, buy some type of hybrid deal that'll be safe as a buy and hold until we can add value and sell for top? So I really think it's important to look at the economic cycle to see what strategy you want for any given time period and for any given asset and for any given investment strategy, which we'll talk about in a little bit. So in 2007 and 2008, as I mentioned, I really did not understand the importance of these cycles and the factors on the economy. I had an education, I had a college degree in management with a minor in finance. I was trained as a financial advisor, and I worked with very ultra high net worth individuals, banks, and institutions at AIG, putting together hedge fund investments for their investment portfolio. And I thought I knew quite a bit about money and quite a bit about investments. And I was completely blindsided when we hit the 08, 09, not only recession, but real estate collapse. And I worked for AIG, which was going under, and had no understanding or idea of why at that time. So what it did is it made me understand I really don't know what I don't know. And the more you know, the more you realize you have to learn. So I decided to become a student of economics. And through that, I had just started really investing in rental real estate and realized, just as an aside, that no job was 100% safe and no entrepreneurship, which we had just started my husband's business, was 100% safe. But what was doing really, really well were my buy and hold rentals. And I knew that I had to buy more and to create more passive income. So while I like value add deals and I play in that space in large multifamily, At heart, I am a buy and hold investor, and I want to buy assets that I can continue to hold for a long time that can generate that true passive income that creates the financial freedom that we all want and that I was able to experience through investing in apartments. So through my studies, I really started watching things like federal interest rates, yield curves, unemployment rates, building supply prices, supply and demand. And it became clear to me in late 2018 that we were probably on the cusp of heading toward a recession. By January or February of 2019, we were in, at that point, the longest expansion period in history since President Abraham Lincoln had been in office. And in late 2019, we passed that. Rates were increased by the Fed at the end of 2018, and things started to get shaky, and they very quickly retreated and lowered rates again because of that. And then we started to see some inverted yield curves. And essentially there's several different yield curves, but investors and economists watch short-term bond rates compared to long-term treasuries. And when the short-term bond rates have been higher than long-term treasury rates, and there's certain ones that they look at, and they stay there, it has predicted the last 8 recessions and now 9. So that is something that I started really watching and thinking, I need to start getting a little more conservative. I need to look for kind of some hybrid value add buy and hold deals. And I need to buy well-located areas, investments in areas that I knew were very recession resilient. And many of my friends and people who I respect very much were like, you're way too conservative. You're probably way too early. Our economy's booming. And I'm like, I just feel like there's some rumbling. So I started selling properties, thinking we were at the high about a year earlier than what we were, and started to kind of hold some cash and look for recession resilient assets. Also, unemployment rates were very low and wages were rising. And while people tend to think that unemployment rates that are low and rising wages means we are in an amazing economy and it's just going to keep going, typically what happens is when you get super low unemployment rates and wages start to rise, it predicts the end of the high. And that happens just before we head into recession. So I shifted my strategy before COVID to recession resilient investing. And really this one decision is what I believe allowed me to really weather the storm of COVID with my investments very, very well for my portfolio and my investors. And I'm just so thankful that I recognize that. Okay, so some multifamily challenges that happen during recessions, and then we'll talk about how COVID exacerbated these things, is we start to see job losses, we start to see reduced wages, we start to see reduced demand for sexy amenities and luxury expenditures. And so in apartments, people will stop paying to live in that Class A apartment building in Houston, Texas, where they have valet dry cleaning, valet parking, dog walking service while they're at work, valet trash, etc. And they'll want to stay in that Class A area or a very nice Class B plus and pay $300 a month less so that they can still stay in a nice area, but not quite pay for all of those luxury items. The consumer sentiment starts to go down and people start to fear that they may lose a job. And what we do see also is that a lot of times right in the beginning of a recession, that people actually have increased debt because of the high spending at the peak when they thought everything was just going to continue to do well, and they decide to go buy the nice BMW or to upgrade their apartment. They spend on clothing and eating out, and they just think it's not going to end, just like I did in 2007. And this leads to tenants seeking reduced rents. Class C assets and Class C tenants are hit hard. They're already living check to check and don't have savings. Over 70% of Class C middle income to just below middle income individuals typically have about $40,000 to $50,000 in debt, in addition to school loans, and about $4,000 saved. So when they're already check to check and essentially have no savings, a recession hitting them blindsided tends to hit them pretty hard. Class A tenants tend to move to Class B assets, and Class B apartments tend to be the most resilient, and that's been proven over and over again. So before recession is peak or hypersupply in many major metros. So what this means is that a lot of new construction apartments are trying to lease up, and they're trying to keep up with demand. And at some point, the supply and the new inventory coming on the market exceeds the demand. This is especially true in Class A, newer builds, because most new construction is Class A. And so when you have this phenomenon where you're already oversupplied, it becomes harder to lease up those units, and you start to see concessions, and they're hard to fill. Well, if you then have a recession that also decreases demand because people now can't afford those sexy amenities that they could before, it really leads to problems, especially in that Class A market, but really in most multifamily to some extent, where we see increased vacancy, we see increased concessions to try to fill them. So they might, discount first and last month's rent just to get somebody to move in. We see increased bad debt with a recession, and ultimately rents have to come down because of that decrease in demand versus the supply. Operators struggle to stay over 90% occupied, which lenders obviously require for stabilizations, and your investors need to be stabilized in order to be paid. So in the COVID pandemic, this was all significantly worsened. We had mass layoffs, mass shocking, immediate layoffs, mass unemployment, fear, both of the catching the virus, as well as fear that they were going to be the next people to lose their jobs and not be able to feed their families. There were risks of more shutdowns. For the first time, we saw businesses that we never thought about being able to be shut down, deemed non-essential. Doctors, dentists, orthodontists, chiropractors like my husband, attorneys' offices, restaurants, insurance companies, basically anybody that wasn't manufacturing or Lowe's or Home Depot or a bar in a lot of places were shut down. And so we had this new era of legislative risk that, quite frankly, we had never seen. And in all the ways that I try to mitigate risk and things that I see ahead, never could I have imagined that the government would throw out contract law and say, we're sorry, Mr. Landlord, you might have a contract, but you cannot evict people now if they don't pay. And they don't even have to tell you that they can't pay because of COVID. You can't evict anyone that doesn't pay for any reason. We saw in certain areas rent caps as well, and freezes on rents. And those kind of things are very scary to multifamily operators who depend on rents in order to pay expenses, pay the mortgage, and pay their investors. And we've seen a lot more people staying home, which has actually impacted us in terms of our utility costs for operations, and in terms of the number of maintenance calls and work orders submitted by people that are now cooking for the first time, that are used to eating out. And people are starting to really tighten their spending overall. People were caught again by surprise with high debt and very little saved, not unlike a typical recession, but even worse in this one. Unfortunately, many people weren't able to collect unemployment for months. So it took a very long time for unemployment benefits and the CARES Act additional $600 a week to come through for many tenants. And so that was very, very difficult for many families and many of our renters. And again, for many of our tenants that maybe have their own businesses. I had a hair salon owner, and I had a guy who is a landscaper that were renting from me, and they were not able to get their PPP for months. And so they struggled to pay rent. Tenants became unable to pay rent. And the other thing that we saw was a very big uptick in certain communities in the number of people that just skipped. They just broke their leases and left because they knew they couldn't pay. They moved back home with mom or dad, or they moved in with another roommate, and they just stopped paying. So we talked about the contract law being overturned and eviction moratoriums. And the eviction moratoriums really put landlords in a position for the first time that were unable to mitigate the lack of payment by just replacing tenants. And where, typically if somebody doesn't pay, you try to be gracious for a little bit, you file eviction, they're eventually removed and you put somebody in that can pay rent. When you have a large swath of people in a particular area that are impacted and can't pay, and suddenly you can't evict them, not only through the CARE Act, but also at the state level and at certain local levels that have different layers and complexities of eviction moratorium, it becomes very difficult to figure out how do you continue to pay bills if you can't get people to pay rent. So many operators were unable to pay their mortgages and investors after expenses. And we worried that we might not be able to, because not unlike anyone else, we had no idea how long this was going to go, how bad it was going to get, how long these shutdowns were going to last. And so we had to really jump into gear to try to mitigate as best we could our operations and to stay stabilized. We saw property staff getting sick and unable to work, very high stress environment. So you have property managers and maintenance people, leasing agents who have kids that are now suddenly home from school that they have to figure out how to help homeschool online while answering all the calls from tenants who are stressed out and can't pay. Increases, as I alluded to, in maintenance issues. We saw a rapid rise in number of people complaining about their AC or their heat or their stoves or their fridges or their washers and dryers. And yet they didn't want people in their home to come work on them. And the maintenance people felt very overworked. We had contractors who were shut down and completely quarantined as well. So in many different areas, and every state was a little bit different, certain contractors were shut down just like anyone else. So some states you couldn't have anybody come and mow grass. Or cut down trees. In other states you could. It just depended on whether your state deemed them essential or not. But essentially much and most of the value add construction that multifamily operators were doing had to be halted. And so you ended up with many value add deals that had to wait months to be able to continue their renovation plan, fill those units, and stabilize their properties. Lenders were not quick to offer forbearance despite what was on the news media all the time. And in fact, Fannie and Freddie made it to where you basically had to already be unstable and next to bankruptcy in order to get a forbearance, because you had to prove 1 month at a time that you couldn't make your mortgage payment. Well, if you can't make your mortgage payment 1 month and you can't make your mortgage payment another, it means you probably don't have reserves. And they are going to deem you not a stabilized asset. And the other thing is that even if they did grant the forbearances, if you accepted a forbearance that extended the eviction moratorium essentially, so that if you took 6 months, 8 months, and it kept changing, 12 months, 18 months to get back into a normal payment rhythm and be made whole, you couldn't evict anybody in your complex until you got out of forbearance, which would really create this perpetual cycle of, I can't pay my mortgage, so the bank's not letting me evict people, so less people pay, so I still can't pay my mortgage. So it was a very, very difficult situation to think through and to think about, and for those that actually had to go into forbearance, and many have or will lose properties as a result. So we had to adapt as operators very quickly and go into triage mode. We became very proactive. We personally, myself and my partners decided to be very compassionate and to have constant tenant communication. We offered our tenants rent discounts if they would pay early, in order to show that we needed them to pay in order to continue to provide them housing. We understood that it was going to be difficult and scary for them, but if they would prioritize rent, we would get through this together. We would take care of them in their community. We waived late fees before the mandates came down that said that you had to. And we also decided to try to help our tenants in any way we could. So we provided them links and documents on how to apply for unemployment compensation and how to apply for PPP if they had a small business. We did some stress management webinars for them and had a consultant come in and talk about navigating stressful times and navigating change. And we did some, drive-by breakfasts and things like that, just to try to let tenants know that we really did care. We did need them to pay rent, but we wanted to continue to be, a place that they could call home and that they could feel safe from being evicted, but that we needed them to catch up, and we would work with them. We really went into heavy cost cutting mode. So we tried to do everything we could to continue to provide nice housing without really cutting quality significantly, but by cutting costs everywhere we could. Unfortunately, in one of my complexes, we did have to lay off a second maintenance person before we realized that we would see a massive uptick in maintenance requests. And through the PPP, we were able to hire them back. But that unfortunately was a decision we had to make for one of our properties. And we went back to our contracts and we renegotiated hard cable contracts, landscaping contracts, insurance policies, everything we could to cut costs to offset the reduction in rents. Again, we had constant communication with our investors. We talked to them about what our plans were, a worst case scenario, and in our mind, what that would be, how we were mitigating, whether and when we would stop investor distribution so that we could hold some extra cash to get through the pandemic, make sure that we stay stabilized enough for the bank not to try to put us under lockbox, and then resume payouts at that time. And we made different decisions for each asset, but it was really important to us to communicate very, very often with our investors. And then the same with our lenders. We called the lenders well in advance to say, if this thing gets really bad, worst case scenario, what happens? What if we had to go into forbearance? Would that prevent us from being able to take additional future loans? Would it implement the institute the bad boy carve-outs for our non-recourse loans, et cetera? So we made sure that we were constantly communicating where we were and what our options were. And we weathered the storm with 95 to 99% occupancy and collections through COVID. So we were very, very blessed, but it was very, very hard fought. We did it largely because we predicted and prepared for a recession in our underwriting. And I can't stress that enough. The large assets that we bought in the 1.5 to 2 years leading up to COVID, every single one of them, because at the end of 2018, I said, I'm a little nervous. I think a recession's coming. We were conservative in our rent growth projections and our rent bumps and the level of renovations that we thought we needed to do. So for example, where some complexes all around were saying, we're all going to go to the stainless steel appliances and granite countertops. We knew that in one of our complexes, the tenants had been there for years and years and years with a wait list with old countertops and bisque appliances. And I said, let's test one or two. But I have lots of other units in this market and people pay top dollar with white appliances. So do I really think they're going to pay $50 or $75 more for stainless steel? Probably not that many. And so we were conservative to say, let's make our units nicer. Let's paint them, put in vinyl plank flooring, paint the countertops to look like granite, an inexpensive backsplash, but let's not do the stainless steel appliances and granite. And guess what? We well exceeded the rents that we got even without doing those things. So you had to kind of know your market, but know where you thought your consumer and your renter might go if we head into a recession. That helped us. We only put in 2% rent bumps starting in year 2 and no rent bumps starting in year 1 for all of our deals starting in late 2018 all through 2019, because we said, what if we head into a recession? The average value add deal is 3 to 5 years. And if a recession does happen, its average recessions last 18 to 24 months. So even if we made it to year 2, we might be in year 3 and 4 in a recession. And so we were very, very conservative in our numbers, and thank God we were. It's really what allowed us to do very well. So this pandemic, if anything, really affirmed my belief that we must understand economic cycles and be very conservative at or near the peak. It's very hard to do when we have colleagues that are doing these great value add deals well into the peak, and they're like, it's never going to stop, it keeps on going. And you start to get conservative and you have people outbid you on deal after deal after deal, you become a little, you start to battle with yourself. Am I being too conservative? Should I just do what everybody else is doing? Am I missing out on deals because I'm too conservative? And what I'm here to say is when you're at the top of a market and it's at the longest point in an expansion, stay conservative. It's better to be conservative and miss out on deals than to be too aggressive when you think you might be heading toward a recession and end up regretting it, especially if you have bridge debt, which many Class C value add deals do. So those doing value add Class C deals and expecting continued upside with bridge debt have been hit the hardest. I know many other investors who are in situations and have been through COVID where they are essentially battling with their lender to not take over the property and lose their investments because they were expecting continued upside. They have bridge debt. They're not able to get the rent bumps that they wanted. They're not able to get construction workers to do the construction. And as an aside, construction costs have gone up significantly. So we couldn't have necessarily predicted this piece, but through the pandemic and the supply chain disruptions, the cost of lumber tripled in cost in many parts of the country, where 2x4s and subflooring literally were triple the cost over the last several months, just starting to come down. So you're slow and inability to turn units as quickly and to get the level of rents that you hope to get from those mass CapEx infusions really put people at a disadvantage when they were not able to lease up and stabilize those properties quickly. And in talking to a couple of my lenders, what I learned was that most forbearances, those loans that actually did go into forbearance, were loans under 5 million, were syndications, and were Class C assets. And that is part of why, just for example, the Freddie Mac small balance program is so much more expensive and has harsher rules than those deals above 5 million. So the agencies really took a look and said, hey, there's more risk here. And that's why your pricing is the spread on pricing between small balance deals under 5 million and those over 5 million is quite a bit wider in a post-COVID world than it was before. They're also looking at syndications with large numbers of investors where people who are KPing that are not actually an operating partner, a managing member. And so those are just some things to keep in mind, that most of the syndications that you've probably seen have been, Class C assets, lots of investors, KPs, and a lot of them, at least for newer investors, are under that 5 million, but there's some that are larger as well. So just to kind of, recap on this piece, not to beat a dead horse, but the, economic shifts require strategy shifts. So when we have a rising market, value add deals are great. When we start to see a declining market, we really should think about shifting to a buy and hold model, or at least a hybrid with an extended timeline. And I'll tell you, my sweet spot for investing is still Class A to B areas with a little bit older building, a B or C building in an A or B area, where I can hold that deal long-term if I need to and still cash flow. So I'm banking more on the income than I am the growth right now, and looking for deals that are going to have some asset preservation characteristics. So I want deals that are going to have upside, and of course where I can force appreciation on a value add, but I'm looking for lighter value add deals where it's a management play, or where I'm buying a deal from, 100 unit from a mom and pop investor who has not raised rents for, 4 or 5 years, and they're truly 200 below current market without doing anything. That's the kind of deals I like to go in, because I can put a little lipstick on the pig aesthetically, raise those rents $200, and then plan to, hey, we're going to hold this thing. We'll hold it 5. And if 5 isn't back up and, well into past recovery, back into growth, then we'll hold it 7 or 10 and we'll enjoy the cash flow. And if we really want our money back and turn that IRR, we'll do a cash out refi and we'll keep the asset long term. But I've really shifted from primarily value add before into primarily a hybrid of a buy and hold value add deal, or just buy and hold deals for my own portfolio. Economic shift also really require you to know your investors' shifting investment strategies and risk tolerance. And this is also very, very important. So when you talk to high net worth individuals, and most of us, when we're doing syndications, we're looking for investors who are high net worth individuals, who are accredited investors. And most investors, no matter where you are in life, we go on this trajectory and this continuum of, in the beginning, early in our lives, we're looking primarily for investments that are going to bring us income. We're, in our early childbearing years, and we want the cars and the houses and the vacations and whatnot. And then after our income needs are met, then we start focusing primarily on growth. We want appreciation and big chunks of cash. And then over time, we've built our wealth, and we want very hard to preserve everything that we've worked so hard for and not lose it. So we become much more risk averse as we go. Well, this same thing happens with your sophisticated, and especially with sophisticated investors who have expendable income and a higher than average net worth. And so what happens is, when you are in a rising market and high net worth individuals already have, money set aside, their income needs are probably met, they are going to prioritize growth. So they're willing to wait for the investment for 3 to 5 years, maybe longer. They just want that big chunk of cash at the end. So they love value add deals. And their second concern is income. They want something that's going to pay them, 7, 9, 10% cash on cash return. And they're not that worried about preservation. They can take a little risk on a deal by deal basis because they've got a high net worth and they've probably got a well-diversified portfolio. And in declining markets, really wealthy investors get really smart and they say, hey, there's pain ahead. I don't want to invest in anything where I can lose money. I have my income needs met. I'm not going to take as much risk for a big payday at the end when I see that there could be economic pain for a few years. I would rather invest in solid deals where I can preserve my capital. And it's the same reason that right now institutional investors are buying top dollar multifamily assets. Class A and B assets go for 4 caps. It's crazy to us that want income and growth, because you say, how can you make money on this? Well, they're not looking for growth and income. They're looking for preservation of capital. And so multifamily is a flight to safety when you're in these high, nice, brand new, large institutional level assets. And it's the same with our investors. So they become much more concerned that they're going to invest in your deal where, how are you going to guarantee me that you're not going to lose my money if people can't pay, and if the pandemic persists, and if moratoriums persist. And so we need to consider doing deals that are more conservative with longer term fixed rate debt, assuming that our investor tolerance is like what many are right now. And that's a concern about not losing money, having a little income. That's a priority over and above wanting deals that have big growth in exchange for risk. And again, everybody's investor network may look very, very different. Some of your investors might really, they might be younger and they might still be very, very bullish and willing to take some risk for the upside. Or they may not understand the economy and economic cycles and the risks that are involved. But it's your job to make sure that you understand their investment strategy, their primary investment strategy, and their risk tolerance, and whether and how it has shifted as a result of this recession and this pandemic. So choosing recession resilient investing, and we're about to wrap up here due to time, but for those that want to continue to invest during a pandemic, some people say, should I be investing right now? Well, just like with the stock market, you can make money in any market. It's just a matter of how much money are you going to make and how reliable is that money, and how well are you going to do making it without a significant amount of risk. And so during a recession and heading into a recession, it's important to invest only in deals that are going to be resilient during that recession. I hate the term recession proof because there is no such thing. And if the pandemic taught us anything, it means nothing's recession proof, pandemic proof, anything proof. But we can buy things that are going to give us resiliency. So I invest in areas with a growing population that's not stagnant or declining, in areas with stable employers and a lot of diverse industry. And the diversity of the employers in the industry is super important, especially in an age of a pandemic where we saw that towns that were very heavily in one or two industries are hit much, much harder in shutdowns. Or if you're in an area like Atlanta, Georgia, or Houston, Texas, where there's such a strong mix of tech and hospital and education and manufacturing, et cetera, they were much more resilient. Invest in areas where rent prices are reasonable versus home ownership. So this is important too, and kind of goes back to once you get in the Class A rental space, it's very easy for those people to just say, hey, rates are low, I'm going to move and buy my own house. Where if you're investing kind of in areas that are Class B areas, or maybe C+ areas where the rents are reasonable compared to home ownership, you might do better. Invest in areas with low unemployment and below average vacancy rates. It should go without saying, but I see a lot of investors chasing yield and going to places because it looks like they can make these huge returns without really knowing those markets well. And I like to pick on Oklahoma City because a lot of my investor friends were deciding to start investing in Oklahoma City. And when I started researching the fundamentals, I was like, oh my goodness, the average vacancy rate in Oklahoma City over the last decade has been 14%. So how in the world do I trust that all these investors are going to give me deals that they're going to get it at 96% occupied when the entire market is at 14% vacancy and has been for decades? So that those kind of things are important to know. Invest in areas with strong hospital systems. So there's been some interesting reports about through the last several recessions on areas that have weathered the storm the best, and without fail, all of them were anchored by a really strong hospital system. Research hospitals like MD Anderson in Houston, Baylor College of Medicine, CHOP, Mayo Clinic, et cetera. Invest in areas, this is obvious and really important, with more demand than supply. So where there's less rental competition, you have to know how many renter households are and the size of those households compared to the rental units that are available for them. So one of the things that's important to know right now is migration patterns. Because of the pandemic, and it was already starting before, we're seeing mass migration. Sorry, Alina and you guys out of New York and New Jersey and out of California, and many people are moving to Texas and Florida and Georgia. And Pennsylvania. We've seen a lot of new homeowners and a lot of new investors from New York coming to my area of central Pennsylvania around Hershey and Lancaster. And it's because taxes have gone up significantly, but also because they were more heavy-handed in dealing with shutdowns and lockdowns and continued lockdowns. And they're coming out and saying, oh, by the way, we're also about to raise your taxes. And so when that happens, people start to say, you know what, it's just not worth it anymore. And they move to areas that have low taxation, more conservative governments, and where jobs are going. So it seems like every month a major employer is leaving California and opening up a plant or a business or a tech firm in Texas. And so when jobs leave, people are forced to eventually leave. And it's really important that when we're looking for recession resilient investing, if you have a super high net worth and you have a super long-term outlook for decades, sure, maybe you can buy some really cheap property in New York City right now, but you're probably going to do better and be more resilient as an investor to first go buy some properties in Texas and Florida and Georgia that are going to weather the storm for a while. Invest in areas with, again, conservative government taxation and policies, and also where there are multiple end buyers. So one of the things that's important to me, and I'll tell you a little bit about a couple of the deals that I've invested in, is that there's multiple exit strategies and multiple different buyer options. And so if I can go into like a Class A area with an older building that has a very high barrier to construction and new units are not going to come online in that area, not only might I have institutional investors who want to buy that property at the end, in addition to all of the other syndicators like us, but I might have construction firms that are going to tear down that building and build a high rise. And so that's, another strategy. And then invest in deals that can add value or be strong for longer holds. Invest in deals that can add value for longer holds. Buy for cash flow during a recession and don't bank on the appreciation. Sure, we want growth. I always model it in, but I'm investing only in deals that cash flow day one. I'm going to try to increase that cash flow, but if it doesn't cash flow day one, I'm not just relying on interest only payments in order to be able to cash flow. And that IO is a carrot that dangles at us, which is good to use, but it can entrap us into paying too much for deals that otherwise wouldn't make sense. Another thing that I'm doing is I'm buying smaller units. There's just a lot less competition for smaller apartment buildings than there are for, that 100, 150 unit, especially in major markets. And quite frankly, I make much higher returns on the smaller apartments than I do on my larger assets. You must be very well capitalized and have reserves. During COVID, if it's taught us anything, it's proved that this is critical. I don't like to have cash sitting. Every time I have cash available, I try to find something and I put it down on another property. And I've had to become very, very disciplined to wait until I find really great deals that cash flow day one that I would hold long term instead of being kind of rushed into, the idea that I have to do another deal. So keep some reserves, at least 6 months, 6 to 12 months of reserves. And some of the agencies will make you do that. Have multiple exit strategies. Choose debt wisely depending on where we are in the cycle. I could do a whole presentation just on this topic, but it's extremely important that unless you're extremely experienced and you've been dealing with bridge debt and you've been a player through, other market cycles, that you not start doing big value add deals with bridge debt while we're in a recession. Just try to lock in low rate financing. Evaluate deals and rent growth projections with a view to the next 5 to 10 years. So instead of looking for 3 to 5, expand your horizon a little bit. If this pandemic yields a 2-year recession, like an average recession, then we're still probably 5 years out until we're in a growth phase, because you're going to have 2 years of recession, 2 or 3 years of recovery before we're even back into a growth phase, which is why, hyper supply usually peaks, somewhere between 7 and 8 and 10 years before you hit another recession. Don't sign on loans for others, no matter what, because the bad boy carve outs on non-recourse financing, if you look at your loan docs carefully, if you don't make a mortgage payment or they think that you didn't, handle your property well, they could take everything you have, and it could trigger the bad boy carve out. When I talked to my lender early on, CBRE, Freddie Mac deals, about what if I had to go in forbearance, would that trigger the bad boy? They would not put anything in writing because they said, listen, go to this page. Technically, if you don't make a mortgage payment, you trigger the bad boy clause, which means it becomes recourse instead of non-recourse. If I have control of those decisions and I'm asset managing my deals, which I am for the vast majority of them, I'm comfortable signing on loans for deals that I have some control of. But one of the things that I see a lot of others doing is signing on loans for other operators with no control whether or not they can pull the trigger if something's not going well. So just be very careful and learn the art of patience and only investing in deals that are going to be recession resilient. Alina, do I have 5 more minutes or am I over?
You can go, Anna. Yeah, you have 5 more minutes. We'll leave 15 minutes for questions, but then we'll have to wrap up the questions quick.
Great. So I just want to give you 2 examples of deals that I've bought during this recession. just to, show that there are still deals out there. You just have to be very, very careful what you buy. If your mindset is the same as mine, that you should buy recession resilient. We recently closed a property called Augusta Court, which was a 150 unit Class B multifamily property in Houston, Texas. I'm from Houston, Texas, so I know the area very, very, very well. And where this complex is a Class A to B minus, I'm sorry, A to B plus area. It's just a little bit older building. It's the area that everyone wants to be in. Everybody goes to for nice high-end dining, shopping, coffee shops, spas, to meet their friends for lunch or brunch. It's just the area everyone wants to be in. It has been for as long as as long as I can remember. So probably at least 30, 35 years, but the area just keeps getting nicer and nicer and everyone wants to live there. I knew this complex because I used to not be able to afford to live there and I wished that I could live there. And I dated someone that lived there. So when this came up, I knew this is an amazing asset. It's in an area with a very high barrier to construction. So it's very dense, and people are coming in and paying millions of dollars to tear down 70s and 80s vintage buildings just to build really nice new skyscrapers. So we know that we have multiple exit strategies. We can sell to an institutional investor who wants Class A area assets. And if we update the 1988 vintage properties into Class A type vintage with higher end appliances, then we will probably find an institutional investor to pay top dollar, because it's in an area that's considered an area that's very safe, that will bring them that preservation of capital as well as some income. There are lots of diverse employers nearby. Within 10 miles, there's a couple hundred employers. The tenant pool in this area, 70% are single with no kids. And so that it's a lifestyle location for most of the people that live there. And those that live in the suburbs drive into this area at night to go into fine dining. The income earners are well above average and were very lightly or not at all hit during the pandemic, which was important. They made on average $67,000 a year for a rent that's about $1,200 a month. So well within affordability for them. It was an older building with much larger units. All of their one bedrooms have a den. And because of COVID and so many people working from home now, it gives them the ability to have a home office. And as is, there were $300 below market versus smaller and slightly newer units that present about the same, because this building has been updated once before several years ago. It's just that their updates are slightly now updated. We also got a $2 million discount after COVID. So we were under contract pre-COVID, fell out of contract and negotiated a price discount. And that discount allowed us to have a much nicer cash on cash return. Our underwriting was very conservative because at this point we bought it during COVID. So we said, let's anticipate that this recession is going to last a while. We're going to show no rent bumps in year one, even though we know that as soon as someone moves out, we can paint it and charge $300 more per unit without doing anything else. We felt like, let's just in our underwriting say no rent bumps at all year one. We also factored in 8% vacancy and 14% collections. That's very high for this area, very high for this demographic, and very high compared to what the seller was actually experiencing. But we wanted to make so sure that our investors were going to do well on this that we decided to stay very, very conservative for this deal. This is a picture of the property. So it's like well located right within a highly populated area, but there's a long pool there, kind of cool aesthetic. And there's a lot of green space. You can't really see it, but within all of these units, there's a lot of trees and there's courtyards that are really pretty, that give you a sense of quiet and serenity, even though you're in the midst of everything and really close to just about anything you could want to do. And we're going to update the aesthetic and the outside and the interiors and make them nicer. And then the last larger asset that I did was a syndication called Element 41. It was a 494 unit Class B plus asset in Marietta, Georgia, which is a suburb of Atlanta. And this is a Class A minus area, very high in demand, a very beautiful property. It's on a couple of acres, and there's a lot of green space and beautiful outdoor space. There is an outdoor gym, which people just loved during the pandemic because you could go outside and kind of like an adult jungle gym and do different activities. And we've contracted with a group that will do different outdoor classes like Pilates, et cetera, with space to spread out. There's a little soccer field. There is like a shuffleboard area, nice pools, just a lot of outdoor space where people can go and breathe and walk around. And our institutional investor will be our end buyer. So when you're dealing with a 494 unit, syndicators like us are not usually going after those deals. It's usually the much larger players, but they don't want anything that they have to update. And this unit, although many of the units were updated, it's been several years, and so they're a little outdated. So we will update all of the units so that when we go to sell, we will be targeting an institutional buyer. There are many diverse employers. Atlanta is extremely resilient. There are many Fortune 500 companies there and moving there because of the tax incentives to do so. And Marietta has above average income earners. It's a $400,000 medium home price in this area. And again, we were conservative in our underwriting, and we said no rent bumps at all year one. And just by year two, very modest updates, we know that we can achieve a rent bump because we are undersupplied. There is much more demand in that area than there is supply, and we're already below market. And so that is key. And this deal, we were able to offer a 7 to 9% preferred return. The 9% pref is cash only, no upside, and the 7% pref as a second tier of investor will have upside, and we anticipate about a 15% IRR. We held over $1 million in operating reserves, and we have a very strong, experienced team on our other two assets there just outside of Atlanta. In two other suburbs, we were able to actually achieve 28.5% rent growth even through COVID, and our rents are continuing to go up. So it was an area that we're familiar with, that we've already been operating in, and therefore we were comfortable moving forward with that asset even during a pandemic. And there is a picture of Marietta.
It's beautiful.
Lots of green space and kind of adult pool. You roll the balls and lots of different pools and outdoor barbecue pits. And then this is an example of one of the already renovated units. So we're basically just matching the renovations that they've just been doing, and we're going to finish them. And we're anticipating the same rent as they're already getting consistently with the wait list.
Amazing.
And that is the end of the presentation. So I'm open.
Thank you, Anna. This was amazing. I wish we had more time for you. I'm sure there would be a lot more information, but yeah, amazing content. Thank you for sharing a really good presentation. I have a few questions accumulated. So question number one, you mentioned that you've become a student of economics yourself, and it helped you along your journey. So for someone who would want to follow your footprints, what would you recommend? Any specific books, courses, anything else, maybe podcasts?
You know, I really haven't done any courses. There is a good book that I will recommend, and full disclosure, he is a partner of mine now, but he wasn't when he wrote the book and when I enjoyed it. But it's a Bigger Pockets book by Jay Scott called Recession Resilient Investing.
Okay.
So he came out with that actually just before the pandemic, and it has a lot of really great information from a real estate investor perspective. I also just started studying different journals, and so I worked at AIG, and one of the things that I wanted to understand when we had the last crash was, how did I work with mortgages and at Bank of America when I did private banking? And how did I work with all these high net worth individuals and be in the division that almost went under because of these credit default swaps, which was insurance that one corporation has on the value of another. And how did I not understand where the risk was when that's what my company did? So I started subscribing to like mortgage periodicals. Mortgage News Network is one that I watched, and I started reading industry periodicals on discussions about the economy and where we were headed from a mortgage standpoint. I started understanding, and what really helped me through the whole eviction moratorium and understanding what could happen with interest rates and with lending drying up as it did, the mortgage-backed security market drying up, as I had been reading about the fact that mortgage companies were now hedging their bets by shorting mortgage-backed securities again, just like they did pre-2009. And I thought, how is this happening again? And then when COVID hit and the pandemic hit, I saw that 55% of servicers were within a week of bankruptcy because they shorted their own mortgage backs in order to hedge their interest rate risk. So it's just things like that. Look for subscribe to economist reports. You can just Google them. I can send you a list. I just don't have one handy off the top of my mind. It's late, but I just started. I read books, and he's kind of he's pretty much always bearish. But Harry Dent is a really good, very smart man. And he's talked about some of the economic risks that make our economy less stable than what we think it is. And some people absolutely can't stand his writings because they're mostly negative and things are going to collapse, and say that he's, smart, but only right part of the time. What I have learned, Alina, is that there's so much complexity. And the more I learn, the more I know I don't understand. And
Sure.
so when people ask me every week, where do you think the economy's headed? I'm like, well, this indicator and this indicator and this indicator tell me that we're probably headed for more pain. I don't think, for example, we're going to bounce back, and that as soon as the vaccine comes, our economy is going right back to where it was. Because being a student of the economy, I realized we were heading to a recession before the pandemic ever hit. Most news media, CNBC, Business Journal, Business Review, they're going to tell you the economy was great before COVID and we're going to be right back where we were, but they're missing some of those indicators. So read a variety of different economists. If you're reading people that are, hey, everything's going to be amazing, read some people that are a little more curmudgeonly pessimistic about the economy, and you'll learn a lot just from reading.
Yeah, oh, absolutely. Great suggestion. Yeah, if you have a specific list of publications or books, I'll take it afterwards at your convenience so I can share it with the group. That'd be great. Okay, next question. What does a recession resilient asset look like? What kind of criteria in your estimation does it have to meet?
I think that question probably came up before I did those last couple of slides.
Sure. Guys, whoever asked the question, if you're still looking for clarification, feel free to unmute yourself or post if you'd like.
Sure. But primarily, Alina, just at a high level recap, is you want markets where there's a lot more demand than supply. When you're in the peak of an economy and in hyper supply, it means that in most major markets, there's more supply than there is demand. So you want to go where the people are going, go where the jobs are going, go where there's going to be constant influx of demand. And then you want to find markets where there's less supply that they can't keep up with the demand. While that happens usually in a growth phase, we're seeing it now even in a recession. This is a very strange period of time where we are in a recession, but yet certain parts of the economy seem to be booming as if they have blinders on and they don't see what's really happening. The stock market is still generally high. Single family home prices are still skyrocketing. Multifamily assets are holding their values despite eviction moratoriums. We're in this phase that doesn't make sense and look like anything we've ever seen or anything that I've ever studied. And so I still think that values are going to come down, and that the pandemic, once more companies, their PPP runs out, we're starting to see more layoffs. And I think that as there's more pain, It's going to be important that if there's another round or there's more, job losses, you need to be in areas where there's a lot of diverse industry, where if people lose their jobs, they can go back to work at another employer, and where they need a place to live, and they're willing to pay slightly higher rents because they have to in order to find a place. So supply and demand, strong industry, lots of growth and migration into those areas. Class A to B areas, if you can find older buildings, really strong schools, really strong hospital systems. I have said no to participating in co-sponsoring with about 3 different operating groups in the last several months, people who I really, really like. But the reason I said no is because they didn't have these boxes checked for recession resiliency, or they anticipated that by next year they're back up to 3% rent growth and all these sexy amenities are going to make people pay a lot more money, where I'm saying, I think there's a little more pain ahead for a couple of years.
Absolutely. Excellent points. Thank you, Anna.
Sure.
Guys, I don't see any more questions. Feel free to unmute yourself or post your question in the chat. So Anna, when you're looking at Class B to A area, the asset itself, and that's more of clarification for others, the asset itself, does it also have to be B? What if it's in a more of a beat up shape? Would you not consider it if the area is already, B to B plus neighborhood? Would C class asset?
I love finding older buildings in nicer areas. So I think we make a mistake when we see and we read like, don't invest in A class or B class or C class, and it puts it all together. The reality is we have the class of the area and then the class of the asset, which is why I really like your question, because I can change an asset all day long, but it's really, really hard to change an area.
Yep.
People speculate and move into an area thinking that they're going to continue that regentrification and it's going to happen in 2 or 3 years. Sometimes it takes 10 or 12 or 15 years. So I don't want to go to a Class C area and make it the nicest one there so that people pay me a little bit more. Because if they still have the same employers and the same jobs as everyone else in that area, then if they're hurting, they're going to pull back and they're going to stop paying as high a rent. I want to be in the A to B area where everyone wants to be, because it's where their employers are, it's where the nightlife is, it's where the restaurants are, it's where their friends are, it's where their good schools are. And the people that are willing to stretch their income because they want to be in that area are still looking for affordable housing. So I like apartment buildings that, are 70 to 90 units that don't have necessarily a pool or a gym, but they're in a really great area. People don't care that they don't have that. I have a lot of older tenants who don't want lawn care anymore. They want to live in the really nice area. I have tenants that now don't want they don't want a gym. They want to work out from home. And so I'd rather take an older building with fewer amenities, make it really nice, make it crisp and clean and look updated and new, but be in a really nice area. It's never going to be a Class A or B plus asset because it doesn't have the same amenities, but it's going to be a nice place that people are going to want to stay and live, that's more affordable than everything else that's way above their budget.
Yeah, no, absolutely. Great answer. Thank you, Anna. Next question. How do you really define Class A, B, or C? Is it focused on price, rent, types of jobs? And yeah, I'm not sure. Omer, do you mean Class A, B, C for the area or for the property?
I can speak to both a little bit. I mean, typically, Class C apartment building, and people have a very broad, wide definition of what they consider C or working class, okay? Basically, your A class area is your nicer, wealthier areas with brand new construction. Because they're nicer and newer, people have been moving there more frequently and there's a lot more new construction. So A assets typically, are brand new to maybe 10 years old. And people will still call a 12-year-old asset an A in certain areas. Another one will call them a B. But, generally your newest decade or just outside of that assets in an area that's really becoming very strong, high income, lots of new jobs and restaurants and stores opening up. That's your A areas. Your B areas are slightly older than that. So maybe they're not quite your brand new suburb that's popped up that has everything happening, but maybe it's a 30 or 40-year-old neighborhood that once was the wealthiest neighborhood in the area. They're suburbs, they're nice, people want to live there, they've got really good schools, but the buildings are older. Maybe they're 20 to 30 or 40 years old. Class C is like your average working class, middle income neighborhood. So, you know, the vast majority of buildings in the country are probably Class C buildings, but there's a big spectrum as to age and as to neighborhood crime and schools within Class C. But it's basically your average middle income to just below average income housing. And then D is a war zone. So you don't want to be in, you know, gunshot wards, inner cities.
Excellent. Thank you so much, Anna. Guys, any final questions? Feel free to unmute yourself if you'd like to ask. And it looks like you've covered more than people can handle there, because there are no questions. Everything seemed very clear, and you did do a fantastic job with your presentation. So we really, really appreciate that. Well, to respect everyone's time, including Anna's and our audience, we're going to wrap up. And again, thank you so much. This was phenomenal. We really, really appreciate it. I see people putting in the chat that it was a great presentation. Thank you so much. Guys, as always, I will share the recording in a couple of days. And if there are any follow-up questions, you can reach out. Anna, do you want to put out your information, or how do people connect with you or reach out to you if they want to ask anything?
Sure. So my email is info@reimom.com. You can follow me on Facebook at Anna Mom Kelley. My website for coaching and speaking is reimom.com. And for investments, my investment company is greaterpurposecapital.com.
Awesome. Again, thank you so much. Thank you, Anna. You guys have a great evening. Talk to you later. Bye. Bye, everyone.